talks that I gave in Silicon Valley. That was a great intro. I really appreciate it.
I learned it all from Derek, so you know. So we what a marathon, right? 27 hours.
We're not done,
It
too.
was like 3 or 4 stops, and after this, we're going out to Kitchener-Waterloo tonight. And again, we started like our first meetings at 8:30 tomorrow morning, and going right through, and then just deposit the empty body at the airport and get it in tomorrow. Yeah.
I'm really impressed with what's happening here in Toronto and just this whole greater community. You know, I see a lot of startup community, so I can give you a sense of maybe you don't know. It's like there's some special stuff going on here. Places like Mars and DMC and
Digital Media Zone, yeah.
Digital Media Zone and Communitech, and it's really incredible. So you're lucky to be doing startups here. Did some great stuff. You have some challenges on the investor side and venture and how much, or lack of how much money is here, but I think that's going to change. I have a feeling that there's something really special going on here. So, I'm glad to be here.
So yeah, so one of the things that we've discussed or has come up time and time again is the difference about investing in potential, that potential big, which is your focus, is really that consumer, like the notion of having 100 million users is not, beyond imagination for you. And so we reached out across the ecosystem here, and we had 55 that we put on the list. And despite giving his profile and advising, all of the investors, about half of them we got back were enterprise. And that's kind of, I think, a byproduct of the investor ecosystem here. You got to be profitable faster, and you got a customer, so it's going to be a business, and that whole thing. But I'm asking you, it's like, so you're investing in potential, so how do you divine that? And then, what gives you confidence, before you did Friendster, or before you did, had it in your experience, that, you can invest in growth up until, 100 million users before you start to really worry about it?
Yeah, so I don't think I had that confidence until after Friendster. Like, it's really counterintuitive. I mean, the notion of a Snapchat, or I think Instagram was the first big wake-up call for everyone. Like, how could that company be worth $1 billion? They're not making any money. It wasn't even massive scaling at that time. It was growing very quickly, but it wasn't nearly the numbers that we're seeing like WhatsApp and others. But, way before that, from my experience at Friendster and Bebo, I quickly understood the power of networks and growth when it comes to consumer companies. So one of the things that, maybe it's a misnomer, Maven and I care deeply about having good business models and making money. Businesses are built around that, right? So we never lose that. Even on the crazy, high-flying, hyper-growth consumer companies that we look at as investments that I did as an entrepreneur for 20 years before I was an investor, they all had a business model. It's just that the question is, when do you turn on that revenue stream to potentially, that might damage your network effect. It may dial back your growth, but dial up your revenue. That's the only question, right? It's like Instagram had a revenue model. It's just they didn't want to turn it on because it was going to impact their growth. And it was all about getting to hypergrowth so that a second follower wouldn't catch up and try and take over their position. It was smart, and it worked, and they got acquired. But even if they didn't get acquired, that would have been could have been today one of the most massive social networks with huge revenue streams competing with Facebook. So I think it's important to keep that in mind. We do care about making money and having revenue. It's just when you turn that on. Now, specifically to what I've learned here in Toronto, because you don't have a lot of capital that's going to say, hey, you know what? Here's $3 million. Go get a team, 3 more people on your team, and go build this thing out for another year and a half, and don't worry about making money. Right? Like, you're probably laughing. You never hear that here. You hear that a lot in Silicon Valley because we know there is a revenue model there, but we also know that you're getting some nice consumer traction. The engagement's off the charts. People are coming back every day. Let's build this into a big, big business from a consumer standpoint, and then we'll focus on the revenue. Right? When you have investors here who understand that and who will be able to back those kinds of businesses, there will be a Snapchat built here. I'm sure. You guys are talented enough for sure and creative enough. It's just a matter of having the right kind of people to give the risk takers, the entrepreneurs, the ability to take that kind of risk.
Okay, so you did a talk today at Highline, so we're going to get into some of those points today. But, again, to this notion of potential, there's kind of 2 or 3 stories that you've told me over the course of February and this that I think, it's like being there story. So a little bit about sort of being around the table early days. So he was also entrepreneur in residence at Charles River Ventures. Charles River Ventures, by the way, is an investor in Pebble. Pebble was our first guest, and I know you guys know the Pebble story. He wasn't there for that, but he was there when Twitter was sort of going through its, whether it was a dog or whether it was a great investment kind of thing. And so, maybe a little bit about that whole experience and nothing that you can't tell, but what it was like to divine it, what Twitter was going to be.
Nothing. I think it wasn't obvious that Twitter was going to be successful, frankly. I mean, it was a tough call. Like the CRB investment came about because the partner at CRB who invested in Twitter's previous company, Audio, which was a podcasting company that failed, was able to keep a little bit of the shares. I think a previous speaker for Startup Run, Ariel, he was also involved. He was on the board of Audio. Unfortunately for him, he wasn't given the opportunity to get these shares in Twitter. Fortunately for the partner at CRB, he was, and he took them. Now, they built that business, and I don't know if you guys remember the fail well, like it constantly was failing. And for me, it reminded me of the early days of Friendster. Does everyone remember Friendster, the first social network? Yay. So that was the $200 billion business that should have been, that wasn't, mostly because of technology issues. And there were some other issues that we had. I've written a white paper on it. A lot of people ask, like, why did Friendster fail and how did Facebook win? Well, I actually wrote the 10 reasons why. You can get that on Maven Ventures on my website if you really want to spend an hour reading an essay that I wrote. It was also almost sort of cathartic, Fortunately, I was okay writing it because we did very well at Bebo, but it could have been a very painful experience. But, look, Twitter reminded me of Friendster. Like, it was not working. But what was amazing to me is nobody out-Twittered Twitter. Like, there wasn't the Facebook of Twitter to come along and put them out of business. And that's actually an interesting essay to think about writing, and I thought about blogging that. Why did that happen? I think it wasn't clear exactly what Twitter was. Like, it was kept changing and morphing, and so, like, when you looked at Friendster at the time, it was very clear what they were doing. It was easy to copy that. Twitter was kind of like weird. It was kind of, in some ways, technology was easy to copy, but the product was challenging to copy. It was also somewhat technical and not as consumer-facing, and so I think, for whatever reason, entrepreneurs just didn't jump on it and say, I'm going to out-Twitter Twitter, and eventually they got the technology working, they got some good people in there, and eventually they scaled. Personally, I still think the jury's out. I don't know where that company's going. I mean, I use it as a marketing tool. I don't find it as useful. It's kind of really noisy for me personally, and I think I hear people who love it still. A lot of people don't use it anymore. Some people find it, we can debate where that's going. But at that time when I was at CRV, it was not clear to the partners at CRV that was going to be a big business. And the round, I forget, it was $250 million round for their Series A or B. It was like the next price is a B. That's a lot of money for a company that was failing all the time with a team that had a lot of infighting. And, they passed. Now, they did fine. They did great because it was so early in the first seed round. But, it wasn't intuitive, and I think...
So you just described a $250 million round as a Series B?
Yeah, it was early on. Right, it was a tough... This thing was scaling, and it was one of those crazy... Like, do you go that high on that kind of valuation?
So what's a Series A round?
Gosh, there's so much written now.
I know,
today?
Yeah, but, in the valley, I'll chime back with what it is here.
No, I think that's unusual.
10K.
I think you have like this pre-seed round that's like a friends and family, a couple 100,000 get started. This is the typical, right? Then you have like a seed round, $4 to $6 million cap note, $750 to 1.25 ish. Maybe you include the initial money in that kind of round, 1.5, you round it up. Then you have your Series A, 3 to 5 million, 5 to 7 million. We're seeing, especially if you're going to go for larger VCs, they want to put 5 to 7 million to work. Then you Series B are all over the place, like that.
Right.
Those companies, I have one in my portfolio that's probably going to raise, $20 to $25 million for a Series B. They just closed their Series A 7 months ago. It's a little frothy right now. I have other companies that are looking at a Series B, like 10 to 15 million. It's kind of depends on where you're at with the business and, how well you are negotiating, getting VCs excited.
Scott, how does that measure up with Series A here, Series B here? Actually, it didn't sound that far off on the seed and angel.
I think the pre-seed seed accuracy is there. It's the kind of,
friends and families up to $500,000 of spare change in government money.
Right.
And then you're doing up to $1.5 million of angel and potentially maybe institutional money. There's not a lot of institutional players
Right,
that
on an A.
under that level. And then
Yeah.
I think you cap out at Series A about $5 million.
Yeah, that would be like maximum.
Yeah.
So there were 8 and for SoftBank, and some of them were Series B officially, and they'd be looking still 5 to 10. Some of them were looking for 20 million. But
Yeah, and look, it's some momentum. Does anyone here use Product Hunt? You guys know Product Hunt? So it's a product discovery app. It's got a lot of buzz because the early adopters were the venture and micro VC investors. And they did a $2 million seed, like under the radar, and then they did another $6 million 4 or 5 months later after they graduated from YC, $6 million Series A. You've seen that, and there's no revenue, and it's pretty good numbers. I mean, it's a decent engagement.
So how did they get that? How did they get those early users? How did they get, I mean, who's behind that?
Well, that's
Was that first round?
Oh, well, the
That
founders.
that early adoption with,
Such an influential group.
Well, so Ryan Hoover's a very clever guy, right? So this is not by accident. The founder and CEO has been doing growth hacking for a long time. He was a gaming company before Playhaven. I met him there. I actually could have been the first check-in product on, and maybe I'll regret not doing that. But I think I just would have bet on him. I didn't really see the big vision. I know how powerful it is for our kind of small tech community. I think the jury's still out whether they can scale that to be a very big business. Many of those companies that invested, it's self-serving. Like, it's good for us. It's good for me. I would have supported him, and I would have supported the notion of having this because it's a great discovery mechanism for my early stage startups. If I get an early stage startup on Product Hunt and they get their first 5,000, 10,000 customers, that's awesome. So it's great to support that. Can you take that and pivot it outside of the small tech community into,
Is it like beta list out of Europe?
I don't know.
Okay.
Yeah, but I mean, the idea is like, anyone could talk about, hey, there's this new great game, go play it, or this new great software product, go check it out. And they've got hundreds of thousands of people looking at this, and they're pretty avid. So maybe it'll scale. But by the way, he's written a great blog of the heavy lift. He went door to door in the very beginning, saying via email, hey, I'm thinking about starting up this company that will discover new products in the tech community. You want to check it out? He went to his group. He talks about it very openly. He's very open about this. So if you do a search for Ryan Hoover, how did I start Product Hunt? Or it was doing the things that don't scale or something like that. Then he's written a follow-up blog to how he went from his first 3,000 customers that were all literally friends of friends inviting people to the next 30,000. And that was a different kind of growth hack experience. So it's actually really interesting if you're going to do that.
Okay, so again, to this trying to activate imagination, and then we'll get into the brass tacks. So at Bebo, take us to the moment. Take us to that moment where it was like, wow, this is on fire. This is going to be an experience of a lifetime, or maybe one of 3 if you're used to doing billion-dollar companies.
Yeah,
But,
right. I'll talk a little bit about one of the things that we always look for at Maven. Like we have certain filters, and those of you who heard the talk earlier, heard some of this. We're always looking to work with companies that have what I call a vision worth fighting for, right? So what does that mean? It means that you're solving a problem. This is we do 100% consumer investing, but by the way, this also I think would serve you well if you're doing an enterprise company. You're solving a problem that needs to be solved. Like what are the problems that consumers are having today that you are passionate about solving? So there's a couple of pieces of that. One is you're passionate about this. It's not something that you think it's a good idea, you hate the thing and you'll be bored, but you're going to do it. It's like you really care about it. It could be solving the problem for yourself, someone in your family or friends, or just something that really grasps you. Why do you need that? Because building startups are a really hard business. The hardest thing you're probably doing in your life. And most of the time you're going to have trouble. It's not going to be fun. And if you don't have something that you're really passionate about, that's a vision worth fighting for, you're going to give up. This is natural. You probably should, If you have that passion, and it is a vision worth fighting for, and maybe you could persevere and build an Airbnb. You could build a $10 million company. So when you also think about a vision worth fighting for, so how big is this market opportunity, right? So like with Bebo, obviously with social networking, I knew at Friendster that there were tens of millions of customers we weren't serving because the site didn't work. We already had 15 million customers. There were tens of millions we wouldn't let in because if we did, it would just keep, the servers would keep failing. So I knew there was a massive market opportunity. Facebook wasn't on the scene yet, and MySpace was starting to get some traction. So it was clear to me that we were solving a problem, and it was a very big problem, which is people are lonely. So this is a way to connect people. People are looking for dates, and they didn't really want to go to dating sites. They were hooking up with people through Friendster in a sort of more natural, safer way, especially for women. So, massive problem opportunity. But, Friendster was already getting scale. Facebook was coming up in the scene in college in the US. MySpace was starting to get a lot of traction here. So we looked at Europe, English-speaking Europe. What a great opportunity, completely greenfield. Turns out that the founder of Bebo is British. So we used sort of his innate sort of, his comfort with the culture to use the language that would attract people in Europe, especially UK, Ireland, Australia, New Zealand. He was born and raised in London. So we also targeted the college and high school demographic. It wasn't like, this genius idea. We looked at, hey, it's working here for Facebook. We'll do the same thing over there before they get there, right? And I knew about the power of network effects from my 2 years of working at Friendster. So if we got there first, we actually had a good chance to build a big business. And then the last piece, again, I was thinking about the strategy was, if we're number one over there, that's a very big business. We know we can make a lot of money on advertising to this demographic when we have tens of millions of people there. And by the way, we think it would play well in the US because the younger demographic in the US might be interested to be connected to their colleagues, to their high school buddies and college friends, or people in that age demographic over in Europe. It's kind of cool. That was kind of the theory. And so we launched it. Fortunately, it worked out. And we became number one in Europe, number 3 here. The interesting thing about being number 3 here is we were essentially number 1 here. Because Facebook was, by that time, 2 years later, they were going public. They already told Yahoo they're not taking the $1 billion offer. MySpace had been acquired by News Corp. So we were number 3, essentially. If you wanted to buy a massively growing social network in the US, Bebo was it, even though the lion's share of our traffic was in Europe.
So what was that moment between, that was the theory, and it worked out? That you were just like, oh, this is actually happening.
Yeah, so, there's certain inflection points. We tracked everything. We were very careful about it was a team of 4, so we had 2.5 engineers and me, so it was mostly engineers on the team, and all the engineers were product managers. So every week we'd have meetings about product meetings and feature discussions, what we think would move the needle, and then we built the product and we tested and iterated. Every 2 weeks we had new features, new major features, minor features launching, killing things that weren't working, A/B testing, and there were certain points, and we actually looked back at the graph. We went out and raised a round about a year into it with Benchmark, and so I had all the charts, and there were certain blips, and you'll see this a lot, especially with consumer social products. You're kind of going along, it's like, blip, and then you're going along, and then there's these moments, and sometimes you can actually point your finger. We got promoted by Apple there, and it took off, right? And sometimes it's that plus some press. In our case, there were a couple of things. We got on the Today Show of London, the morning show, and that was a huge thing. They actually, I usually end my talk on this thing about luck and timing, but Bebo is by far the luckiest company that I worked with, and I'll tell you, I'd much rather, you hear this, but it's so true, I'd much rather work for a lucky company than a great company. Because you can't control that stuff, right? Some of it we set ourselves up for luck. I would say that one of the things that entrepreneurs, sometimes it's hard to hear, is that luck and timing is going to be 90% of your success, which is out of your control. Now, the thing is, though, the piece that is in your control, right, you need to do. You need to have incredible idea. What's that?
It's like, oh, great.
Exactly. But here's the good news. You can create some of your luck, right? Great team, great vision worth fighting for, great market opportunity, and mostly like working really hard and being open-minded to seeing those opportunities. Ask yourself this question: how else do people do this today, right? So like this comes up every meeting I have, and it's something that I push back. Even if I think I know the answer, I want to hear the entrepreneur founders articulate this, right? You have to be able to say it in a sense, we're solving this problem, it's really important to do, and we're the only ones that do this, or we're doing it a million times better because of X, Y, and Z. So like, this came up today at the meeting. Some guy, it was actually a very interesting idea, someone was doing...
Is the guy who was there today here, who had the restaurant app?
Yes, it was a restaurant app. He wanted us to build an app where it tells you the best dish at a restaurant. Actually, I love that too, it's kind of cool. But then you start thinking about it, what's a big market? Like, everyone goes out to eat, you know? But, I mean, how many people would want that? If you had an app, you could find out. You know, and so we polled the people there, but half the people raised their hand.
How many people would want that?
Yeah. Okay, but now that you start thinking about it, how do you get that information today? I mean, anyone, what, Yelp? Yeah,
Yelp.
Yelp is definitely, I mean, I do. They give you the top 3 recommendations in their review.
Ask the waiter.
Ask the waiter, someone else said that, right?
Luddite.
Yeah, look, there are other sites, the point is, if there are ways to to solve that problem today, you should be very, very scared about your vision. It doesn't mean you shouldn't do it, but building a new consumer habit is one of the hardest things you can do, okay? So if you're not doing something completely revolutionary like Snapchat, which is ephemeral text messaging, and it's kind of a simple concept, but at that time it was revolutionary, right? That was a new way for young adults, and now all of us, to communicate in a more emotionally connecting way with pictures, and it goes away. Wow, no one's ever seen that before, and it worked, right? That took off. Solved a problem people didn't even know they had. Those are the best consumer companies. Now, there are other companies like WhatsApp solved the problem. Texting was around, it was massive text, but they solved a specific problem with international texting, made it free, very reasonably priced, and they just focused on that, maniacally, just focus, right? And if you're 100 times or 1,000 times better, you could potentially succeed there, right? But ask yourself those questions and make sure you're really comfortable, because if you don't think you're solving a big problem that's worth fighting for that you can't otherwise solve right now, don't do it. Do something else. You guys are talented. Find something else.
Agent, quick question.
Yeah.
So you mentioned about Series A, Series B, 250 plus. Now that's a big amount.
Which one, for Twitter?
Well,
Yeah.
That's an
Well,
exception.
Yeah, that might have been a Series C. I mean,
right.
yeah.
So either way, I mean,
It's a
you don't
lot.
see that kind of money in Canada. So
Yeah.
my question is, are we in the wrong city?
Oh.
And is that a reason that we don't see Facebook and Snapchat?
This is where you pull out the talking points about, Section 116 and lower tax
That's your
rates
stuff.
and all that.
No, I think those deals are very unusual. I mean, Twitter was funded at that because, Facebook was going public at some massive number. I mean, Uber is funded at these levels. Look, there's a trend going on right now where these late stage, Series C plus CDs and Es are at massive valuation, billions of dollars. And on one hand, people are like, bubble, bubble, bubble. I'm not waving the bubble flag. I think we're a little bit frothy on valuations, but these are rational businesses, as opposed to the 2 bubbles that I've lived through, that many of us here have lived through, where they were just irrational businesses. There was no business there, and they were raising money at billions of dollar valuation. Uber is a business. I mean, it's a great business, and you could say that the valuations are getting ahead of themselves, but there's another way to think about it. One way to think about it is, why should the public market get 90% of the upside? And that's what private investors are saying. Why don't we come in downstream and put money in at a $10 billion valuation before they go public? Why should we let the public investors make all that money on the IPO and then post-IPO? So it's actually not an irrational thought. In fact, it's such a rational thought that we're seeing billions of dollars flowing into late-stage deals. It's going to keep going.
So it's not due to the regulatory burdens of going public?
But I think
that's what everybody's sort of
I think
waving
there's
the flag
there's
about.
some of that.
IPO is not where you make, I don't think the IPO is where you make the money anymore.
Yeah.
As an investor, I agree with you.
Yeah.
I think it's before, that's where the trend's showing.
That's why smart money is flowing in. It's not honestly the reason why why this company that I was mentioning, one of my portfolio companies might do a $20 million Series B deal is because those late stage investors, the Fidelities of the world, the sort of hedge fund investors that were doing only public, now doing the Uber Series E rounds, or looking at Series B and C rounds. So I don't know where this is going to go. Maybe that becomes a little bit irrational. Maybe that's a
But
little
it's
bubble.
also the companies, if they are tending to go public, and the trend now versus, let's say, 10 or 15 years ago, is that they're going public at much higher valuation.
Yeah.
They're much larger companies. They've been established, they've been around, they've been doing business for, let's say, 8 or 10 years, and then they decide to go public, as opposed to doing business for 2 or 3 years and then going public like they were back in the day.
That 99, 2000.
Yeah.
Yeah.
Right.
So yeah.
It's massive difference.
Hi, what are the 1 or 2 big consumer problems that you think which can become big business?
Great question. And by the way, it may have been. I'm happy to share these ideas. I've actually been very fortunate that some of the best investments I've made in companies I've worked with were ideas that I had that I shared with people, that someone told a friend, and they were doing it, and they introduced me to them, and we met, and we had a meeting of the minds, and they kind of pivoted their business to what I was thinking. So I'll give you a couple of suggestions and ideas that I'm looking for. Actually, I'd be happy to invest in companies like this. So one of them is Airbnb for food. Like I've been looking at the food market for a long time, and I think that there's been some really interesting innovation here, which is, I'm a chef or I'm a home chef, and I invite you to my home, and 10 people come for dinner. There's like 15 companies doing that, and there's some really interesting ones, great ones. I don't love that space. I think it's going to be a potentially big business. It's just harder to scale. And then there's the other spectrum, which is, Spoon Rocket and Sprig. And I basically get a warehouse in the city, Toronto or San Francisco. I hire a couple of chefs. We make 3 meals, and we put them in the back of my minivan with a stove, and we run around the city and deliver them in 10 minutes. It's actually really cool. I mean, and they're scaling. These companies, Sprig, I could have been the first check-in. I love the founder and CEO. Is really good growth hacker, hustler. Greylock put in $10 million in their Series A. They're on the path to some success. Again, not a business I love because I don't really want to build another restaurant or restaurant delivery system. Actually, to be clear, the Airbnb for food is all of you are chefs, right? Your neighbor's a chef. I bet you live next to people that are amazing chefs at some kind of meal that you don't know. You might not even know the neighbor. So what I love about this idea is that anybody can be a cook, right? And you actually can make communities closer together, bring the world closer together. And you can potentially help middle and low-income families be able to cook home-cooked healthy meals for their kids, where it becomes affordable as opposed to giving them money to go to McDonald's, which is unhealthy. And maybe we could solve the obesity problem and make a multi-billion-dollar business. So it's a very, very challenging business to scale, and there's a lot of issues, regulatory stuff, but that I'm passionate about, number one. Number two, quickly, ways for weather. It kills me that we don't know what the actual temperature is in 2014, right? And it's just ridiculous. My car temperature is always wrong, or the Yahoo app is 10 degrees off, or Weather Channel. We all take it for granted. We just live in a world where we're 5 to 10 degrees off, and whatever. It said it was going to rain, but it didn't rain. Yeah, well, that's the weather. But actually, you think about it, right? But in our lifetime, and probably very soon, that problem will be solved, right? I mean, between using technology and crowdsourcing of information, we'll probably be able to know exactly the temperature anywhere in the world at any given time.
So the six
Like a
has,
sensor in your window which broadcasts the information in your specific spot.
yeah, the six has a barometer in it, which I just
Yeah.
learned yesterday. Go ahead, what were you gonna say?
So to your first opportunity,
Yeah.
I have the local pilot project for that.
Awesome.
Whoever builds it, come talk to me. I have the pilot team.
We're
Toronto
building it.
housing communities looking to do that right now.
What's
Great.
that?
Which has every low-income person in the city is
Awesome.
part of THC.
Yeah, get me involved too.
I have the investors.
Is that you?
Yeah.
Tech. I
That's
can-
awesome.
I'm
Not his person,
discuss it.
Right.
Okay.
Secondly, there's a team in town called Cumulus
Yes, and I met them.
that's building.
So okay, I don't want to put Cumulus on the spot because he's not here, Jacob, but I met him at a conference in Silicon Valley.
The launch conference.
Yes, and the way I met him is because I gave this idea to the audience, and he came up to me and said, I'm doing that, which is great. Okay, let's talk. So there were a couple issues. The biggest issue for me with what he's doing now is he's actually trying to do both an enterprise and a consumer play. And I told him, if you want to focus just on the consumer play,
That's a Canadian syndrome, by the way.
yes, and it goes back to I have to keep doing the enterprise because I need to make money. I'm like, I get it. Unfortunately, and I've done this now, as an investor for 7 years, an entrepreneur for 20 years before that. If you try and do both, 99% you're going to fail at both. I just said, choose one. And if you want to do the enterprise, I like you, Jake. Just do that. I want you to succeed there. If you love the consumer stuff, I can help you build $1 billion business. You're the kind of guy that I think we could build it around. Let's get a team, come over to Silicon Valley, then maybe you go back to Toronto after 6 months. We run a small incubator at Maven. We build these kinds of companies, and then they go wherever they want to build their team and go from there. We'll help get this, the $1.5 million seed funding. We put a lot of that in. My LPs co-invest, and we have an AngelList syndicate that co-invests. And then we'll help do the Series A, and then they're off to the races. The problem is that he's doing both with a team of 2.5. Good luck. And I just, so I'm blue in the face, I can tell him that, but they've got to make that decision.
That's very good question. Actually, doing both, you don't see, absolutely there is no way that this could work.
Yeah.
For example, if you get more funding, because you're using your sensor, you're using your software, you're using pretty much everything, you're just going to slightly different market. Is it that
Yeah.
difficult to tweak your products, like, to
Yeah.
do both?
I'm glad you pushed back, because that's exactly what happens in every one of the meetings I have with startups, the early stage startups that are doing both. And usually, when I push, like, why are you doing it? Well, usually it's like, well, honestly, we're just not sure which is the one that's gonna take off. And I get that. Like, I've been there, it's scary. And if we choose one, it's the wrong one, we might run out of funding and be dead. We may not have time to pivot, I get it. But my other, the answer is you're gonna fail at both. Like, it's almost impossible to pull off, and I'll tell you why. There actually is a reason why. If you build a consumer company, the kind of engineer, the kind of mindset, the kind of leader you need for that is very different than an enterprise company, for the most part, right? If you're building a white label technical product that's going to sell into professors at universities or wherever he's going to sell the Cumulus data to, that is a very, very different business from the kind of people you need, salespeople, the technical people, who you're serving as a customer, how you're building it, than if you were building a company to service 1 billion people around the world. And your customer is me, the consumer, right?
Right, your positioning, your marketing message,
Your
everything is different.
Everything. And when you're an early stage startup, that's everything.
So you're saying there's so much more difference than whatever the similarities, even though the
Yes.
whole technology is very similar.
Yeah, that's where
it's so
engineers
many
get caught up, is that yes, the
Oh,
technology,
marketing.
yes, right. Actually, I get it now, right? Because the technology is overlap. But actually, especially consumers, on the consumer side, product market fit and language market fit, and we talked about this today, is critically important for your success. So how you speak about the product you're building.
What's the name of the product?
What's the name of the product? Exactly. If it's an enterprise product, it's important, but not as important. If it's a consumer product, it's everything, right?
Still, you cannot do both. Even though you've got different marketing guys, and you still...
It's like drinking out of a straw, or blowing bubbles. It's like one or the other.
Sorry, number 3.
Oh, yeah, I'll get to number 3. Okay.
Alright.
Remind me, though.
My question is more your portfolio specific. I was talking to you about my experience talking to Eric Romo from Allspace.
Yeah. We're an investor.
In virtual reality platform, it's coming out next year. There's literally no metric out there that'll indicate any success just yet.
Right.
Our company is looking at the same thing. How did you guys divine that, borrowing your word, that there's potential and Eric's vision will actually come to realization? There's one question I'd like to,
Sure.
And how do you really come up with the valuation in the first round? Was the seed round 5.8 or?
Yeah, I don't know if he
Series
disclosed,
eight?
I don't want to go through, I don't know if he disclosed or not, but he
Right.
did a round, we were in that first round, and then he realized there was twice as much, I think it was 2 million in the first,
2.1, yeah.
2.1 in the pre-seed, then immediately opened up at 2x the valuation, another 2 million post-seed, so the whole combination seed is, and then he raised a little bit more at a higher valuation, it's like over $5 million seed round,
Right.
which is really an A round, come on, let's call it like it
It
is,
is.
but it was a seed round. And so I'll get to number 3 right now, because the other thing that I do, it was some pattern recognition, because I've been doing this long enough. Whenever I see a new platform developing, that's when I get excited, right? So the internet was the first platform. And I thought, wow, this internet thing is going to change the world. I happened to be in Silicon Valley, I was very lucky. I saw Netscape go public, and I thought, that's the answer. Whoever owns the starting point, the portal, and then became the search engine, is going to be a multi-billion-dollar consumer play. Clear. This is the platform, you own the portal, you're going to own everything, or a lot of it. So I went and looked at, I interviewed at the time it was actually a transition. I went to law school, I practiced law for a couple years, hated it, but it was great training, and I actually got to meet everybody in the Valley. And so I met all the legal people running the divisions at Yahoo, AOL, Lycos, Excite, I don't know if you guys remember some of these names. The challenge was they wanted to hire me as their first or second lawyer. They didn't want me to be a biz dev guy or marketing, and I didn't want to be a lawyer anymore. And then I got a call from one of our clients. CNET was spinning out a small company called Snap. And Snap was going to compete with Yahoo, and we were like 20 people, which was really exciting for me as opposed to being part of hundreds of people. I was really early there. So I left, headed up biz dev, marketing, sales, and legal for them. And then we got acquired by NBC, and we became NBC Internet. We were a GE company. We went public in '99, and we grew to the 5th largest website in the world. So actually my theory was right. Unfortunately, 3 months later, we went from a $6 billion company to $600 million when the Web 1.0 bust happened. So lots of learnings in that 5-year period. But that gave me a lot, I mean, I learned a ton, and one of the things, and frankly, we did okay. We went from 1,200 people to 200 people at the end, and those of us who were there at the end sold it back to GE, and it was about a $300 million exit. But one of the things I learned was like these new platforms are revolutionary for consumers especially. So what was the next one? Friendster. Like, I don't know what we didn't call it social networking, but this is a new platform for people to connect and communicate. Great, I'm gonna join that, and then when that didn't work out, I had nothing to do Bebo. What was after that? 2007 and 8, I was very lucky to be hanging out at CRV, and the iPhone came out. I'm like, hey, this is like the internet all over again. It's a whole new platform for consumers. Nobody's doing anything there yet. So I just did, 5 investments on consumer apps, on this new platform, and one of them was just acquired. So we started in 2008, a company called Check, which was the largest personal finance app. And because we were there first, we were like constantly in the top charts. That company was just acquired by Intuit for $400 million. One of the other companies I did back in 2008 was a company called Tango. Tango is a mobile messaging app. I was the COO. I came up with the name of the company. I was actually there for 9 months, working with them, very hands-on. I put money in the seed round, helped them raise their Series A. That company was just recently valued at over $1.5 billion when Alibaba invested $225 million, and I think that'll be a $5 billion plus exit at some point. So the strategy was new platform. Okay, so then that's the backdrop. What are the new platforms? I think
Bitcoin.
well, Bitcoin we'll get to. Personally, I'm not an investor there. I was going to say I'm not a believer, but I don't know enough not to be a believer. But I am a believer in virtual reality. And so the only question for me in virtual reality is timing. And that actually had a long conversation with Eric. I almost did not invest in that company. I'm glad I did.
He told me that.
Oh yeah, like I was very honest. I'm very honest with him. I said, and he was on his back. He's like, that is our biggest issue. We don't know when there's going to be tens of millions of Oculuses around. And so if you don't have the hardware, like the iPhone and Samsung, all these smartphones scale very quickly. So in 2 years, we had hundreds of millions of people using this product, right? Until we have that with the virtual reality space, it's going to be a small niche play. And so the good news is if you have a good idea and you can build on this momentum now and raise $5 or $10 million, you'll have enough money to last through the year or 2 or 3 year period where it's going to start scaling and hopefully hit that timing right. But it could be like a Friendster, first to market, second player comes in and takes over, right? There's no guarantee.
How many people have questions? Put your hands up real high.
So let me also say one. Wearables. I'm a big fan of the new iWatch market. I think that's another place. And I am looking to do the Tango of the wearables. Imagine you're at a meeting and, a spouse says, hey, you're going to be home for dinner, and you can't talk into it or you're going to be rude. But if you can actually have an intelligent software that knew that it was your spouse, and it gave you an option, yes, no, be home at 6 or something, and you could just push a button without anyone knowing. That's going to happen. Stuff like that's going to happen. That's interesting to me. New consumer apps that need to exist on a new platform.
Okay, I got something for you.
Yeah.
Since Angeles has been catering to accredited investors,
Yes.
with the Jobs Act soon to pass at some point, do you believe that consumers or regular users are going to jump to AngelList and understand that platform?
Non-accredited investors?
Non-accredited.
I'm not sure that I think that's a good idea, whether or not it will happen. The reality is, just because we have AngelList doesn't mean that startups are going to be more successful. So what that means is, if you're going to invest in AngelList, you should think, 90% of these companies are going to fail. I mean, best case scenario, 80% are going to fail, right? I think some people are going to lose a lot of money. And that's why I think it's important that it's an accredited investor, because theoretically they can afford to lose that kind of money, as opposed to people who are going to speculate. Now, the reality is people are speculating and have lost a lot of money in the stock market, so maybe it will go that way. And hopefully they'll invest wisely, like taking some of their savings out of an IRA and saying, this is the risky stuff, right? I'm going to take 20% of that and I can lose it if I have to, right? I don't know where it's going to go, but I think there will be some trends so non-accredited investors can invest through these kinds of platforms.
And sorry, so there's a part B, so they may or may not, but is that, as an investor in AngelList, is that audience a target for you? Like, are you actively positioning the platform in preparation for the Jobs Act?
Well, so the answer, first of all, I'm an investor, so I don't run the product and I don't have any strategic decision-making. I know the founders, but that's their call. But they've been very active in the jobs. I mean,
They were leading.
lobbying, they were leading it, yeah. And they still are. So they're very, very hands-on. Whether they, actually, I'll ask Naval next time. I really don't know what his thought process is on non-accredited investors. I told you what mine is. I mean, I would be a little bit fearful of that. But I think if people did lose a lot of money, we kind of regulate around that. It did remind me of another deal that I'm looking at. It's a really interesting deal. Do you guys do like muni bonds here? You know, like we
Municipal bonds.
municipal bonds, like investing? So here's an interesting idea, by the way, because when you said non-accredited, there's a company I'm looking at 500 startups that's doing the angel list for muni bonds. Well, why is that interesting? Well, first of all, you don't have to be an accredited investor. Okay? Second of all, it's kind of like Kickstarter, right? You guys want to know Kickstarter where you can back projects? But the interesting thing about Kickstarter is you're just donating money. Sometimes you get product, a lot of times you don't get anything. You just support an idea. Think about this. A muni bond is building your local school or your local bridge. And you're getting 3% back. It's like a guaranteed investment. And you don't have to be an accredited investor. I
Yeah,
thought,
there's a startup, here that's.
can you let me know about it? I haven't seen anything.
It's doing on a project basis though, and I
Yeah.
don't know whether it's like actually bonds.
We don't finance our municipalities that way in Ontario. I don't know about the rest of the provinces, but we just don't. It's tax money, and it's municipal taxes and provincial
I
taxes.
think there's municipal bonds.
Anyway, we'll take it offline. If anyone knows anything more about that.
Okay, if you came here to learn something and you have a question, it's burning, get it out, let's go.
So like about angels, you're talking about how like a lot of investors now from around the world can syndicate into pools. Traditionally, angels would provide a lot of advice and help for startups that, you know, on a one-on-one mentoring basis to help them get from, you know, it's not just the money, right? At the end of the day, like that mentorship is a huge aspect of that growth hacking, right? So now with the idea of syndicates where there's maybe 50 to 100 angels or people all around,
Right.
how can a startup be able to get the advice where conflicting points will come into play and all these kind of things that, you know, that is fundamental in making it from here to,
Yeah.
you know, the sky's the limit.
Isn't it great how...
That was right off your slides.
Right?
Yeah.
See, because, I mean, these are the same themes that
He's
come up
got a
over and over.
slide where there's like mentor advice.
It's called
and
mentor whiplash. So I'll talk about mentor whiplash, but I'll first answer that question. So AngelList is not the place where you're going to go find mentors. That's the place you're going to find money. And that's actually a good, I will distinguish that going forward. Yeah, it's a different, and you could find mentors and it's a different, but the basis is to get angel funding, okay? There are other places to find mentors, by the way. There's
Startup Grind just launched a
Startup Grind just
Startup
launched
Grind
it, yeah.
mentor network, if you saw that in the.
There's a company that you can pay to talk to mentors, and they're great. I mean, here in your community, you've got all these great accelerators and incubators, in addition to Startup Grind, that, you know, it's all about mentorship. So that's where you should find your mentors, like a local person who's, now, with that said, I see this over and over again. I call this mentor whiplash. Be careful who you're taking advice from, okay? And I always start by saying, I'm a consumer investor. I know how to build billion-dollar consumer businesses. I've never invested or worked in an enterprise company, a big data, SaaS enterprise, medical device. If you have that kind of business, don't ask me questions. For the most part, I'm not going to understand how to build your business. There's some things that are generic that overlap, and I can help you there, you know, and big vision stuff. But find people that know your business, that have built your kind of businesses, or have invested and been on boards that you really can trust. What you see a lot of times, like a lot of these great incubators and accelerators, is you've got, you know, 50 mentors, and they all want to be helpful. Like, I want to give back, right? And they're giving you great advice. Well, they think it's great advice, but it's completely wrong. You know, I talk to these great, you know, consumer social companies that are getting advice from, you know, former CEO of SaaS database companies. I'm like, look, the guy's been successful, he's very wealthy, I get it. He doesn't know how to build your business. He's giving you bad advice, right? And it's hard to, because, you know, who do you know to listen to, right? So just be very careful about that. But I do think it's really important to get great advisors. Not a lot, but get a couple that will be active and can be helpful for you. And the flip side,
Should they invest? Should they be investors as well, or no?
you know, it depends on their financial situation. If they're wealthy enough, yeah, absolutely. If they're not, and you're giving them equity, that's also okay. The thing that I see a lot of startups failing in is you don't take advantage of those people. So here's how you should take advantage of that. It's a very simple trick, and I have all my startups do this. Have at least a quarterly advisory board meeting, right? It's a really healthy habit anyway, because eventually, if things go well and you get a Series A and a Series B, you're gonna have to have board meetings. You're already in the habit of doing it. You don't have to prepare a deck, although it's a good idea to have a couple of slides about how things are going. And it's a great way to make sure that you're at least checking in with these people that you have identified as your mentors, that they've identified as being your mentors, and that are getting paid, usually in equity, to give you advice and value add.
Okay, we aim to educate, inspire, and connect. Okay, sorry, one more question, go ahead.
Just one question, in terms of like an angel investor's perspective. So let's say you're trying to create a business that's actually very low capital and within the first couple of months in the profit side. In terms of asking for more money to actually scale the business, what's your advice when that should be the case? Because for example, let's say you devise an idea, it's already in the profit within 2, 3 months, 4 months, and you haven't really invested a lot of capital, then it's almost, you get the money, now you have more to spend to actually get the product line out there.
Well, if you're in that position, congratulations. It's great. Look, not every business should raise money. Most startups, outside the tech world in particular, but most startups in the world don't raise venture funds or angel funds, nor should they. I mean, we have this sort of it's like almost become a derogatory term, like a lifestyle business, but there's nothing wrong with that. There's some of the most profitable businesses that are lifestyle businesses. There's nothing wrong with building a very profitable business and you own 100% of it, or you've sold 10% of your company to some friends and family early to get started, and you own 90% of it, or the team does, because that's great. You don't have anyone to answer to. Now, with that said, there are some very great companies that have been built where after year 3 or 4, they're at a scale where they're like, you know what, this thing is just throwing off cash, and I think I need some more professional advice. We're getting people coming in to want to buy it. Do we think we actually go public one day? I do want to scale this thing to be a little bit more professional, but there may be opportunities down the road. And the nice thing is, if you're in that position, you dictate the terms, right? You'll get calls from VCs, their associates have been looking you up and saying, I noticed you were profitable for 3 years, you've never taken any money, GoPro, we want in, let us in, and we'll help you go public.
FreshBooks.
There's a bunch of these FreshBooks, yeah, and that's great. Nothing wrong with that. And some we're like, I don't want your money. I don't want you on the board. I don't want the headache.
Well,
I'm happy to move
the
it.
reason I'm saying is because, like I say, it's a low capital business and it's already making profit. What I mean by scalable is attaching to another network. It's not even about the money. It's actually getting into a larger
Right. So Bebo is in that position. We were profitable. We never needed to raise any money. Actually, the founder, Michael and Sochi, had never raised venture money. This was their 6th company. 5 failed. The 5th one was successful, somewhat, good success. This was number 6. And they never raised any money, and they never wanted to raise money. They only heard horror stories about venture capital and stuff. But I convinced them the reason why we raised money, and we raised $15 million from Benchmark in the UK. We never ever used that money. 15. We never used the money, right? But we did it, and it was the right thing for 2 reasons. One is, I really felt strongly, and I convinced Michael and Sochi, we needed something like Benchmark to put us on a stamp of approval, put us on the map. Like, people took us seriously when they're like, wow, these smart investors from Benchmark, that's a brand name, invested in this no-name company, they must be something, right? Nothing changed, right? But like, to the outside world, that was very powerful, number one. And number two, having someone like Barry Maloney, who was a successful entrepreneur, he was actually very helpful on the board. He brought in a couple people from the UK to build our executive team over there that would have been very hard for us to do, since we were all based here. So there was some strategic reasons to do that. So you have to think about that for yourself.
Can you touch on the convertible note discussion?
Yeah, very quickly. So I actually had my lawyer review that. I am a lawyer, but I haven't practiced in 20 years, so I don't do that anymore. But I did take a look at it too. So here's the bottom line: is it's quite favorable to the investor, to BDC. Much more so. There were certain terms in there that there were like 1 or 2 in particular you would never see in the Valley, and then there were a handful that you'd see once in a while in very favorable deal terms towards the investor. I would say there wasn't anything like super egregious, but it was just very favorable towards BDC overall in general. And I actually can give you specifics if you want to talk about it offline.
But having said that, BDC has led the way in making the convertible note a standard in this country, so we applaud them for that.
By the way, there's a
Yeah.
great article, blog from Mark Suster. I don't know if you guys read it. He's an investor
Yeah,
from
he doesn't,
LA.
he never doesn't like convertible notes.
No, he wrote a very long piece about why he hates convertible notes and it's harmful for the tech industry and startups and why we should only be doing price rounds. And I don't 100% agree with him, but I think there's some really stuff in there I do agree with. We do, at Maven, would probably do more convertible notes and price rounds. We'd love to do price rounds, but if that's where, like Altspace already had their convertible note, we're not going to convince them with our $200,000 check to change a $2 million round for us, right? We can't dictate those terms yet. Yeah.
So I suspect you've invested in a number of YC companies. Have you looked at the SAFE note?
Yeah.
And how does that kind of compare? Do you think the SAFE note is a better instrument for a founder-friendly way to raise money?
I think it's more balanced. And I've invested in 2 YC companies, you know, and it's not a lot. And in part because, you know, the brand of the YC has gotten ahead of itself for the valuations. And frankly, they don't do a lot of my kind of deals, like they don't do a lot of consumer stuff. But they do some, and the last one I invested in was a company called Cruise, which is another sort of future market vision that I was excited about, that I've been thinking about, which is self-driving cars. And you think, well, isn't Google is going to own self-driving cars? That's what we've read about. But really, I mean, Google owns search. What other product have they built on their own? They didn't buy. What's that?
Android.
They bought Android. They bought YouTube. Right. This is
Very successful.
right. So no, they've successfully bought companies, not screwed them up. But they've not built companies that are not like search engine stuff that have been scaled. But even more to the point, massive companies generally fail at building startups. And so actually when I heard Cruise, it's a self-driving car kit. It's kind of crazy. Like really? You can
Attached to the steering wheel?
No, to the top. It's like a little Batman thing on top of your car that has radar. It works now on California 101 and 280. It'll be all over the United States soon. You get on the freeway, you push a button, it's a self-driving car, and you can text, call, go to sleep.
Is it like attached?
It's crazy, right?
Attached to your wheel?
Yeah, so everything is built
Attached
in.
to your-
Yes, the wheel.
You don't have
turns
one in
on.
your suitcase.
I don't. I can show you a video.
If you're going to Kitchener tonight.
There you go. That'd be cool. Yeah, it's not approved here yet. But anyway, so I invested in them, but and the valuation wasn't crazy, and they did a safe, one of the YC safe deals. So I did read the terms there. You know, the truth is,
Must be a great team.
so the founder was the guy. I mean, I bet on him, and he was the CTO of Twitch. You guys know the video.
Yeah.
So and they had just announced it. Well, it was kind of in rumors that was happening. So I asked him, I was like, you were the CTO of Twitch. Why did you go from that to self-driving cars? So you have to really understand this stuff. Like, what's your vision here? What's the passion? So it turns out that when he was at MIT, he was building self-driving cars and robotics. He got sidetracked through Twitch, which was actually a sidetrack of Justin TV. So that he was never a gaming guy. He just happened to fall into this, right? He went back to his roots. So it was great. And it was 4 engineers from MIT that built this thing. They've gone on to raise 2 rounds since then at very, very high valuations. So I'm glad I did that deal. But most of the deals I see at YC are a little bit too valuation rich for me. But the safe, their documents are fine. You know, if you don't have a problem with convertible notes. I'll be sticking around for a little bit if you guys have any other questions.
Okay, so we educate, inspire, so we've heard great stories. We've, had some comments about nodes and about, growth hacking. Last one is connect. I hope that you had, all kinds of ample opportunity to engage in the conversation. It's important to engage with guys like Jim when he comes into town, but more importantly, it's important to engage with each other because, Startup Grind is all about the hardship that entrepreneurs go, the loneliness of, being on this journey. And so you should, make sure that you exchange cards with somebody who's here tonight, get together for coffee and, help with Grind. But thank you for coming. Thank you to Pivotal Labs for hosting us. Thank you to Wilder-Belize, and thank you to our annual members. And Jim, thanks.
Let me just say, I also want to thank. So I'm good on Twitter. So if you guys follow me and you have questions, I'll direct message or reply. And definitely follow Maven. So we're very conscious about the posting. So we really think about either what we're tweeting or the articles we repost are very relevant for building startups and consumer startups. Happy to stay connected to you guys in that way. Thanks for being here. Really appreciate it. It's a lot of fun.